India wants to push manufacturing from 17% to 24% of GDP by 2047. That is a $30 trillion ambition. But in an era of tariffs, deglobalization, and shifting supply chains, can we actually get there? In this episode, Rahul Jain, India head at the Boston Consulting Group, talks about what it takes, the cost competitiveness we are missing, the R&D lapses we need to close, and why uncertainty shouldn't stop us from moving fast. It's Friday, the 5th of December. I'm Anirban Chowdhury. This is the Morning Brief. Hi Rahul, very warm welcome to the Morning Brief.
Thank you. Very nice being here.
So let's start with your field of expertise, which is manufacturing. India has ambitions to take it as a percentage of GDP from 17% to 24%, even as it tries to aim for $30 trillion mark of GDP by 2047. Given what's happening around us, how realistic is this ambition, or do you think we need to recalibrate?
I think firstly, the right push is happening on manufacturing. If you step back, Indian economy has been fueled largely by consumption-led growth. We are a heavily domestic economy, and our very strong demographic profile has driven the growth in the last few years. The agricultural part of the economy is obviously going to diminish over time, and if you want to really leapfrog and get to 10% GDP kind of scenario and reach 30 trillion goal by 2047, manufacturing will have to play a very critical role in that. It requires a complete revamp of many things around us, which is beginning to come together. If I de-average manufacturing growth into three elements, I think the first element is domestic consumption-led manufacturing growth, which I think has been happening. Even in the past few years, we have been growing in line with the GDP growth. But I think that will alone not take us to the required growth for the economy. I think there are two big drivers on top that need to come. One is greater indigenization of imports that we have, and that offers a big opportunity. And the push that the government is doing on both Atmanirbhar and indigenization is the right one. And we see many industries now seeing investments in those lights, whether it is defense, whether it is shipyard, whether it is electronics, renewable equipment, capital goods, in terms of developing those local capabilities, and that could provide a significant impetus. Secondly, I think the export market will continue to be large and available to us. And I know a lot of emphasis goes to the recent turn of events in US, but I'd like to point, the world is very large. US accounts for only 13% of global trade. So the kind of FTAs that are getting signed with various nations, UK, Australia, UAE, etc., and with EU on the cards, it could open up a new gamut of opportunity for us. And I think if both the indigenization piece and the export piece comes together, I'm certain that we can aspire for a significantly higher share of GDP than we have today.
Are there any sectors that come to mind that have not been exploited as much as they should in our path to, the 17 to 20%?
So if you look at traditionally what sectors have led to the growth, both the domestic consumption sectors like steel, metals, cement, and automotive and pharma have been the big drivers of first international foray that we have had. I think those will continue to be important as we look forward. I think the second opportunity that comes are areas where so far, as I said, we were relying on imports, whether it is capital equipment or it is certain chemicals or it is specialized products and specialized metals, which we were relying on the outside world or consumer electronics. So those again could become quite critical. And the third set of sectors are futuristic sectors, where we are taking a bet on becoming a future major powerhouse, whether it is the renewable value chain or it is in future the electronics and the semiconductor value chain. And these have to play out. But I think the right efforts are being put there, and those collectively could play a big role in future.
In this era of deglobalization and tariffs, do you think it's right to keep building for the export markets?
If you look at our economic paradigm, the biggest advantage of India is its own large consumption base. We are not Korea or other manufacturing-led nations who built their base purely for the global market. For us, the starting point of most companies are to meet the large growing demand in the nation itself. And then I think with the drive to indigenization, it opens up more opportunities. As we get competitive and globally competitive, not just on cost, but equally on quality and innovation, India does offer a very reliable, not just material source, but also a talent source and a long-term labor force availability, which is pretty significant in terms of its advantage. So I think we harbor on this strength, and companies who are trying to build scale must therefore get a sizable share of the global market. But the precondition to that is being very competitive on costs. And if I just dwell a minute on each, I think these are not easy goals. On cost, we do suffer from sufficient lack of scale compared to, let's say, some of the China plants. So we need to ensure that we vision at scale, and the private sector does need to think of where they put sizable investments and think at scale. Similarly, the factor costs, which sometimes come in the way, whether it is logistics costs or power costs or costs of managing labor, I think those things also need to be getting better as we get to real apple to apple, both productivity and cost competitiveness. Equally, I wanted to emphasize R&D and innovation. As a nation, we invest very little on R&D. Our R&D spend is less than 0.5% of GDP. And if you look at any manufacturing powerhouse in the world, they invest upwards of 2.5, 3, sometimes even 4, 5%. And therefore, it is incumbent on us to really invest in building the right technology, the right innovation, so that our foundation for long-term global success is well established.
You spoke about cost, and there is another piece of data from BCG that shows that 75% of cost programs miss their goals, and many companies relaunch them every 1 or 2 years. Do you think in those terms we are still chasing optics, and is there a rethinking, a recalibration, a recalculation necessary there as well on the part of companies?
First, to clarify, I think we did that piece of research, and what came out was only 25% of cost programs end up giving results in line with the plan.
Right, I just flipped it, but yeah.
And some of them are moderately successful and some not fully. I think the reason these cost programs don't give results to satisfaction are not because the intent is wrong. I think it is because the full process of getting benefits out of cost programs are not followed. Oftentimes, these are very top management asks, which if they don't have the right buy-in of the middle management, will not give you the full traction and progress that you need. And oftentimes, the change management associated with changing the how and not the what is failing. You can oftentimes really emphasize on what needs to change, how much, what costs need to come down. And we need to equally talk about what underlying enablers need to be in place to take off costs in terms of overheads, to build greater efficiency in terms of actually collaboration with the wider ecosystem and so on. So I do think a lot of effort needs to be put in terms of rigorous program management, change management, but equally on proper stakeholder alignment to ensure these programs succeed.
You spoke about cost of resilience. Do you think it is deeply embedded in the way CXOs think now? Or do you think they're still resorting to, crisis era fixes? And that is the mindset that still prevails.
It's an emerging vocabulary. We have not seen such times over a long century or multiple decades, right? We took many years to build a global supply chain mindset, and therefore to fully factor in resilience in the way you plan, in the way you embed is still evolving. But it's a very, very important parameter in the thinking process. And additional point I would say is that it's no more good to have. It is actually becoming economically relevant. Things like CBAM, which create significant lack of market access if you don't address it in your supply chain, and if you don't embed traceability and ESG and compliance and sustainability in your models, you will not have market access. Likewise, if you don't embed tariffs and what you make where and what you source from where, you will actually not be competitive. So I think these are no more just good to have tools, but they are actually fundamental business drivers. Having said that, I think most organizations are grappling with it and also grappling with the uncertainty, because it's not even that the world order is fully stable right now. People are also tiding through the uncertainty, and uncertainty does delay some decision making. And therefore, what we are seeing right now is people on the long term basis seem convinced of where to go. In the shorter term basis, are taking tactical calls based on when and how they feel certain about different things.
You've called India a swing state in the global sort of economic order. And this is a past, I think, a post or a note that I read. Do you think that's still relevant? And how, in the current scheme of things, in the current scenario, do we use that power to our advantage when it comes to US, China, Russia, the balancing game that we have to play? What do you think?
Today, all global relationships are getting rewritten. In a bipolar world, we've always maintained good relationship with multitude of countries, and that has helped us, and that has been our strength. And I think we must maintain that. And I think that works out as an advantage when we see global companies look at India. They see it as not just a strong consuming base, but also as a long-term politically stable base, which is weighing the tightrope and being a good balancing factor in the world.
Got it. Now, talking a little more about India's advantages, India has, I think, 29 of the world's top 100 value creators. What is the secret sauce, you think? And again, in the current scenario that we are in, the current situation, how the dialogues are evolving with multiple partners and domestic consumption also, how do we capitalize on that?
India is a very strong and fast growing nation. If you look at, we are at 4 trillion odd economy, and whichever forecast you see, we will be a very large force in times to come. And the drivers of that, as I said, are both on the demographic profile, also stable government push and very strong set of reforms that we are seeing. Growth here is a certainty. I think for most of the world, it is a safe place to invest, and not just for the consuming side of the world, but also from the supply chain part of the world. I think where beyond demographics our strengths come from, we have very strong science and STEM background, which is available to us. Second area of strength that comes out is we are beginning to tie up well between big industry and government. And I think the big gap there is skilling. And then the last strength, which is very critical, is that because of the large consuming market, we are less volatile in terms of demand, because our income levels will increase, the spending power will increase. So the consumption base gives you a stable balance of demand for most people. And therefore, in terms of value creation report that you see, the big driver of that are both sectors which are doing well and have a position to dent the global supply chain, and also players which are industry leaders in them. And we also get very strong multiples in our equity market compared to the rest of the world. And this is on the back of the retail investor. And even if the global investors are sometimes not heavily investing, I think on the flip side, equally important to look at what are some of the challenges to think of. I think it's critical to think of how do we address the skilling gap. As I mentioned, you walk to any infrastructure site, you will find that there is shortage of labor there. Today, we need to, as a nation, both through industry and government collaboration, create greater emphasis on skilling so that we can bridge this manpower requirement that is there. The other piece I wanted to talk about, which could be a big challenge, is we don't need only large companies which are end state of the value chain, but also the full upstream value chain. And that requires a large development of the MSME sector, because that's the only way the full ecosystem will evolve to the required level of progress. And therefore, working on driving MSME sector in terms of their access to talent, access to capital, access to getting digitally more connected, common shared resources, will again be another critical factor in times to come.
US-China tech conflict and export controls. India is trying to get into a bilateral trade agreement with the US. We've seen thawing relations with China. How should India position itself without being too binary, if I may use that word?
I think this is a very important and pertinent subject. There are very strong minds working on it. As we think of global market, we should have a very diversified approach. If you look at China and US relationships alone, over a period of time, China has moved from US being its biggest trading partner to now being South Asia and EU bigger trading partners than US. So I think there's a learning in that you can think of the world available to us. And we must have a very diversified approach as we think of collaboration and trade relationships across the world. Equally important for us becomes our own consuming base. And I think what this recent turn of events has done is created a second round of reforms, which could unlock a second round of growth in India, which is very needed. If I can zoom back a little bit, 10 years ago, the mindset was a little bit more to diversify away from manufacturing into consumer sector, technology sector, and go into more sunrise, high valuation industries. What the last decade has done is brought manufacturing back into the forefront. While I think the numbers have not moved as much as we would have liked, I think the early indicators are very well in place. Today, we go not just with the very large companies who are taking big bets on manufacturing, but also the mid-sized companies are locating areas where they can zoom in and create differentiated position. So I do believe that manufacturing has found its place back into the boardroom conversation as a big strategic priority in times to come. Now, to harness its full potential, a lot needs to be done both by industry and government.
And finally, Rahul, from your vast cost and strategy playbook, if you had to imprint one line onto a CEO's plan for the next 5 years, what would that be?
I think we live in very uncertain times, both geopolitics, which we touched a lot, but equally AI, which is one of the biggest
Absolutely.
business changes today that we see. And it could transform fundamentally how businesses get done. The best playbook is not to wait for uncertainty to settle, but how do you continuously traverse through uncertainty and keep agile decision making as way of working is the one who will emerge as successful.
Right. Rahul, thank you so much for joining us.
Thank you. Pleasure talking to you.
So, manufacturing is back in the boardroom, but the hard work is just beginning. India has the market, the talent, and the moment. What we need now is scale, R&D investment, and the will to move decisively through uncertainty. The question is, of course, whether we will act fast enough to make it happen. That's it for today. This episode was produced by Vinay Joshi, sound design by Rajas Naik. A new episode of The Morning Brief drops every Tuesday, Thursday, and Friday, wherever you get your podcasts. Also, don't miss our new shows, Corner Office Conversation every alternate Monday, and ET in the Valley every Wednesday on your favorite listening platform. Stay tuned.